Imagine you've spent 20 years building your company. You survived recessions. You survived supply chain chaos. You survived inflation. Business isn't perfect, but it's profitable. You need a loan to expand, so you walk into your bank. They study your numbers. Review your cash flow. Ask for more collateral. A week later, they say no. Not because your business is failing, because their rules changed. You leave frustrated. Then something strange happens. 48 hours later, your phone rings. A private investment fund is ready to lend you every dollar the bank refused. No branch, no savings accounts, no customers standing in line, just billions of dollars waiting to be invested. The money arrives. Your factory expands. New workers are hired. Everyone wins. At least, that's how the story begins. Because here's the uncomfortable question. If banks stopped making risky loans after the 2008 financial crisis, who started making them instead? And perhaps an even more important one. If the next financial crisis isn't hiding inside the banking system, where is it hiding? Because while the world spent the last 15 years making banks safer, another financial giant was quietly growing in the shadows. Not illegal, not secret, just largely unnoticed. Today, that market manages trillions of dollars. It finances everything from software companies to hospitals, to factories, to data centers powering artificial intelligence. Most people have never heard of it. But if it stopped lending tomorrow, parts of the real economy would feel it almost immediately. This is the story of private credit. At first glance, this looks like a story about loans. It isn't. It's a story about something much bigger. It's about what happens when governments successfully fix one financial problem, only to discover they've accidentally created another. After 2008, politicians, regulators, and central banks all reached the same conclusion. Banks had taken too much risk. The solution seemed obvious. Force banks to become safer, hold more capital, make bigger reserves, stress test everything, lend more carefully, and to a large extent, it worked. Banks today are generally far better capitalized than they were before the global financial crisis. But here's the thing, the economy never stopped needing credit. Businesses still needed money to hire workers, to build factories, to buy equipment, to acquire competitors, to survive difficult years. The demand for loans never disappeared, only the supply changed. Nature hates a vacuum. Finance hates one even more. When banks stepped back, someone else stepped forward. Private investment funds, insurance companies, asset managers, institutions with enormous pools of capital, but without the same role or the same rulebook as traditional banks. And that's the central idea running through this entire story. Risk didn't disappear. It moved. Think of it like squeezing one end of a balloon. You haven't removed the air. You've simply pushed it somewhere else. That's what happened to financial risk. It migrated from the brightly lit world of traditional banking into a much less visible corner of modern finance. Not necessarily a dangerous corner. Not necessarily a safe one either, just one that far fewer people were watching. And that's what makes private credit so fascinating. Not because it's automatically good or automatically bad, but because it forces us to ask a question that financial history keeps asking over and over and over again. When money can no longer flow through the front door, where does it go instead? So, how did we get here? To understand private credit, we have to go back to 2008. The global financial crisis wasn't just a banking disaster, it was a complete collapse of trust. Banks had made enormous bets on loans that should never have been approved. When those loans failed, the financial system nearly failed with them. Governments stepped in, regulators rewrote the rulebook. Banks suddenly had to hold far more capital. They had to prove they could survive recessions. They faced stricter oversight, stricter stress tests, stricter lending standards. In other words, the freewheeling days were over, and honestly, that was probably the right decision. The banking system became far more resilient than it had been before, but every solution creates a new problem. Because while banks became more cautious, the economy didn't become less hungry for money. Thousands of businesses still needed loans. A manufacturer wanting a new production line, a logistics company buying trucks, a software startup hiring engineers, a medical clinic opening new locations. None of them cared that regulators were redesigning the financial system. They still needed capital. Banks simply couldn't say yes as often anymore, not because every borrower was risky, but because every loan now consumed more capital on the bank's balance sheet. For many lenders, it simply wasn't worth it, especially for medium-sized companies, too large for friends and family, too small to issue billions in corporate bonds, too complicated to fit neatly into a bank's increasingly standardized lending model. And whenever demand remains, while supply shrinks, someone notices. Private investment funds did. Instead of taking deposits from ordinary customers, they raised money from pension funds, insurance companies, university endowments, wealthy families, investors willing to lock up their money for years in exchange for higher returns. Then they did something surprisingly simple. They started lending directly to businesses. No bank in the middle, no traditional banking model, just investors meeting borrowers. At first, it looked like a brilliant solution. Companies finally found financing again. Investors earned attractive returns. Banks reduced their risk. Everyone seemed happier. The system hadn't eliminated lending. It had simply changed who was doing it, and almost nobody paid much attention. Because there was no dramatic announcement, no historic law, no opening bell on Wall Street. It happened gradually, almost quietly, one loan at a time. If you were an investor 15 years ago, finding decent returns wasn't easy. Interest rates stayed incredibly low. Government bonds paid very little. Savings accounts paid even less. Safe money stopped making money. For pension funds trying to pay future retirees, that was a serious problem. Insurance companies faced the same challenge. Large institutions managing billions of dollars still needed returns, whether interest rates cooperated or not. Private credit arrived at exactly the right moment. Instead of earning 3 or 4%, investors could suddenly earn 8, 9, sometimes even more. Of course, there was a catch. These weren't government bonds. These weren't blue-chip corporations. These were loans to companies that traditional banks often considered too complicated, too small, or simply too risky. The higher return wasn't free. It was the price of taking more risk. But for years, that trade looked spectacular. Defaults stayed relatively low. The economy kept expanding, money poured in, and the industry grew at astonishing speed. Hundreds of billions became trillions. Some estimates now place the global private credit market somewhere around $2 to $3 trillion. Almost overnight, firms like Blackstone, Apollo, Ares, KKR, and many others turned lending into one of Wall Street's hottest businesses. But there was another reason the boom accelerated: private equity. Imagine buying a company not with only your own money, but with borrowed money too. That's the basic idea behind many private equity deals. Debt becomes part of the strategy, which creates an obvious question: who provides all that debt? Increasingly, private credit funds. One industry became the perfect customer for the other. Private equity needed financing. Private credit needed borrowers. Together, they created what you could almost call a financial ecosystem, or perhaps more accurately, a yield factory. Money wasn't simply invested anymore, it was recycled. Investor money financed loans. Those loans financed acquisitions. Those acquisitions generated more borrowing attracted more investors, and the cycle repeated itself. For years, it looked almost unstoppable. But every financial boom has one dangerous habit. The longer it succeeds, the more people begin believing the success is permanent, and that's usually when the real risks start hiding. Because eventually, there aren't enough excellent borrowers. Only more money, looking for somewhere to go. Now? If this market had become so enormous, why weren't more people talking about it? Because private credit has one characteristic that makes it fundamentally different from public markets. It's private. That sounds obvious. But it changes almost everything. Imagine buying shares of a public company. Every second, someone is willing to buy them. Someone is willing to sell them. Prices move constantly. Good news, bad news, panic, euphoria. The market tells you what people think your investment is worth every single day. Private credit doesn't work like that. A loan might sit on someone's books for years. Nobody trades it, nobody bids on it, nobody updates its price every afternoon. On paper, everything looks wonderfully stable. And investors love stability. Who wouldn't? A portfolio that quietly earns attractive returns without dramatic daily swings looks incredibly comforting. But here's the catch. Something isn't less risky. Simply because nobody is measuring its price every minute. Imagine owning a house. You decide never to check what it's worth again. No app, no estate agent, no valuation. Has the value stopped changing? Of course not. You just stopped looking. Private credit works in a surprisingly similar way. Many loans aren't constantly repriced by an active market. Instead, they're valued periodically using models. Professional judgment, internal analysis, sometimes third-party estimates. Most of the time, that's perfectly reasonable until the economy changes. Because when interest rates rise or an industry suddenly weakens, there isn't always an immediate market price telling everyone exactly how much those loans are now worth. The uncertainty itself becomes part of the risk. And then there's another layer. Who actually owns these loans? Not just billionaire hedge fund managers. Pension funds, insurance companies, university endowments, retirement savings, institutions responsible for millions of ordinary people. Most people don't wake up thinking, I hope my pension has the right exposure to middle-market software companies. They don't even know they have exposure. They simply expect their retirement fund to keep working, and most of the time, it does. Which is exactly why opacity matters. Not because hidden automatically means dangerous, but because it's much harder to judge where problems are building when the windows are fogged. Private credit became one of the most important parts of modern finance without becoming one of the most transparent. And for years, that wasn't a problem because nothing forces transparency, quite like stress. Then, the world changed. Inflation returned. Central banks responded the only way they knew how. Interest rates climbed quickly. For households, that meant more expensive mortgages. For governments, higher borrowing costs. For private credit, it changed the entire game. Remember, many of these loans carried floating interest rates. When central banks raised rates, borrowers didn't just pay a little more. Some suddenly faced dramatically larger interest bills. Imagine running a business that comfortably pays $8 million a year in financing costs. Then, almost overnight, that number becomes 12 or 15. Your customers haven't increased. Your profits haven't doubled. Only your interest payments have. Now do the math. Some companies could handle it, many couldn't. And that's when the cracks slowly began to appear. Not everywhere, not all at once, just enough to make investors uncomfortable. Some businesses postponed expansion. Others refinanced under much tougher conditions. A few stopped paying altogether. Defaults started creeping higher, still manageable, but moving in the wrong direction. Then came another surprise. artificial intelligence. Over the previous decade, private credit had become heavily involved in financing software businesses. For years, that looked like an excellent bet. Software companies were growing quickly, margins were attractive, everything pointed upward. Until AI forced investors to ask an uncomfortable question. What if some of these businesses aren't worth what we thought? Nobody knew the answer, and uncertainty has a funny effect on financial markets. People stop asking, "How much can I make?" They start asking, "How much can I lose?" That's a completely different conversation. Suddenly, the industry's greatest strength, its willingness to lend where others wouldn't, started looking like its biggest vulnerability. Because the same flexibility that fueled years of spectacular growth also meant exposure to companies traditional banks had already decided were too risky. Not every borrower was in trouble. Far from it. Many businesses remained healthy. Many loans continued performing exactly as expected. But markets don't wait for certainty. They react to doubt. And once doubt enters the room, it has a habit of inviting fear shortly afterward. For years, private credit had one simple promise: higher returns, in exchange for locking your money away. Most investors were perfectly happy with that trade. After all, they weren't planning to sell tomorrow. Then the headlines started changing. A few high-profile borrowers stumbled. Some companies defaulted. Others quietly restructured their debt. Nothing catastrophic. But enough to make investors nervous. And nervous investors do what nervous investors have always done. They ask for their money back. There's just one problem. Private credit isn't a savings account. When you deposit money in a bank, you expect to withdraw it whenever you want. Private credit funds don't work that way. Most of their money is already loaned out. 5-year loans, 7-year loans, sometimes even longer. You can't simply call hundreds of companies and ask them to repay everything by Friday afternoon. So when withdrawal requests suddenly increased, some funds did exactly what their contracts allowed them to do. They slowed withdrawals. Some limited them, others temporarily suspended them. Legally, nothing unusual had happened. Investors had agreed to these rules from the beginning. Psychologically, it felt very different. The moment people hear, "You can't withdraw your money right now," they don't read the fine print. They imagine the worst, and fear spreads much faster than facts. Now, let me be clear. This is not a traditional bank run. Banks borrow short and lend long. Private credit funds were designed with long-term capital from the start. The mechanics are different, but human behavior isn't. Confidence is invisible until it disappears, because financial markets often don't collapse when money runs out. They stumble when trust does, and once investors begin wondering whether everyone else is heading for the exit, they start looking for the exit too. That's how liquidity problems begin. Not because every loan suddenly failed, but because uncertainty became contagious. If you enjoy understanding global chaos in slightly less chaotic ways, you know what to do. Now, let's keep going. So, is private credit the next 2008? Probably not. At least, not in the way many headlines suggest. There are important differences. Banks today generally hold much more capital. Private credit funds usually employ far less leverage than investment banks did before the global financial crisis. And unlike subprime mortgages, everyone already knows these loans carry meaningful risk. Nobody believes they're perfectly safe. That matters. History shows that financial disasters often begin when risky assets are mistaken for safe ones. Private credit doesn't quite fit that description. But that doesn't mean everything is fine, because the biggest risk may not be one spectacular collapse. It may be something much slower. Imagine thousands of medium-sized businesses, none of them large enough to make front-page news, each struggling a little more to refinance, hiring freezes, expansion plans cancelled, investment postponed, a factory here, a logistics company there, a healthcare provider somewhere else. Individually, none of them threaten the global economy. Together, they quietly reduce growth. Credit becomes harder to obtain. Businesses become more cautious. Banks become more cautious. Investors become more cautious. The economy slowly tightens. One loan at a time. That's the danger, not necessarily a financial explosion, a financial slowdown. The real irony is almost impossible to ignore. After 2008, the world worked incredibly hard to make banks safer, and it succeeded. But money has never liked barriers. Whenever finance encounters a wall, it usually builds a bridge around it. Private credit became that bridge, which leaves regulators facing the same question they've faced for decades. How do you regulate financial risk when financial risk refuses to stay in one place? Because risk is remarkably similar to water. Block one river, and eventually, it finds another path. Let's be fair. Private credit didn't appear because a group of financiers woke up one morning looking for a new way to break the economy. It appeared because there was a genuine need. Businesses still needed capital. Banks had become more cautious. Someone had to fill the gap, and for years, private credit did exactly that. It financed companies, created jobs, helped businesses grow. In many cases, it worked remarkably well, but every financial innovation eventually creates its own blind spots. That's the pattern. Not because people are stupid, because success changes behavior. When something works, more money flows toward it. Competition increases, standards slowly loosen, risk becomes normal, then invisible, until reality reminds everyone that it was there all along. That's why this story matters. Not because private credit is guaranteed to trigger the next financial crisis. Nobody knows that. History rarely repeats itself with the exact same characters. It simply introduces new ones. The lesson isn't that banks are dangerous, or that private credit is dangerous. The lesson is much simpler. Financial risk doesn't disappear. It migrates. Like water finding the lowest point or electricity finding the easiest path. Capital always finds a way around obstacles. Regulators build fences, markets build bridges, then regulators build new fences, and the cycle begins again. Maybe private credit becomes one of the greatest financial innovations of the century. Maybe it becomes another painful lesson about hidden leverage, or maybe it simply becomes another reminder that the financial system is never truly fixed, only transformed, because every generation believes it has solved the mistakes of the last one, until the next crisis arrives from a place nobody was watching. So perhaps the real question isn't whether private credit will cause the next financial crisis. The real question is this: if financial risk is always moving, are we paying attention to where it's moving next?